Okay, just take note that today is not the usual technical Tuesdays whereby I cover the live market. Yeah, I mean the whole reason why I wanted to do a session today is because I've been receiving some emails from people who attended the live market webinar who wanted a bit more insight into the theory of price action, things like how to plan the trade, how to analyze different time frames, how to tell whether the market is trending or moving sideways. So I thought, I squeezed in a little time to do a more theory-based webinar so that in the future when I do my technical Tuesdays, you guys can understand it better. Okay, let me just cover the disclaimer. So just take note that this presentation is purely for education purposes, does not take into account specific investment objectives or any particular needs for any particular person. Okay, moving along. I mean, it's a great time to do a webinar as well on this topic, trade what you see, not what you think. And any of you heard this term before? Yeah, exactly, John. It's to help retailers of the deep pool learn how to swim. Yeah, it's quite a popular thing. Is there a book on it? Wow. Okay, I might want to buy it. But the whole purpose of coming up with this topic is because, I mean, would you all agree that the markets in terms of fundamentals and technicals has totally been thrown out the window? Yeah, I mean, especially for this year. I mean, you look at Brexit, you look at the US elections, you look at there's so a lot of big market moving events happening for the past 2 years, and more often than not, how the market reacts to it is totally opposite of what we or what a lot of the analysts think. Yeah, and I have a lot of my clients, a lot of traders, um, really getting caught by surprise simply because they refuse to accept what's in front of them. And there's a famous saying in the markets, right? I mean, the markets can stay trending longer than it can stay solvent. All right, it's a classic case because at the end of the day, the market is random, right? So if you see this picture I have in front, I like to use this picture when I do presentations because it's two girls taking a leap of faith. And essentially, this is what the markets are for the past couple of years, especially. I mean, this some of my slides here are pretty old, but it still illustrates the point. Whereby, if you notice, in the beginning, a couple of years back, from 2012, 2013, 2014, I mean, there's this thing called quantitative easing and central bank rallies, isn't it? That means all the rallies you see, like all the stock market, like the S&P, the Dow Jones, the Nikkei, the DAX, the CAC, all the indices are really trending higher and higher and higher simply because central bank has been pumping liquidity into the markets and supporting the markets taking drastic actions, like lowering interest rates to negative rates, uh, asset purchase, whatever you think of, they can do it. And they've been doing this because it's to save the whole market from the credit crisis which happened in 08, 09. And this caused a lot of the stock indices to just move higher and higher and higher. Okay, but the thing is that as traders, right, a lot of us are born contrarian, meaning that we prefer counter trend. And when we see articles like that, okay, it actually fuels our compulsion to want to short the market, because it's very tempting for a trader to try to predict the top and bottom of the market and get it spot on, right? Because number one, he or she will feel like a hero, and number two, there's a lot of meat, there's a lot of pips to be earned if you manage to pick tops and bottoms. But there's a danger in there. There's a danger in there, and that is if the market goes against you, and if you don't get out, the trend can still continue for a long, long, long time. So if you look at articles, headings of articles like that in 2012, 2013, 2014, talking about how quantitative easing will fail spectacularly, 5 reasons why markets are heading for a crash, Ben Bernanke, QE3 work knows already failed. I mean, things like that. And then you got people like Dr. Doom, right? Dr. Doom, what's the guy, Mark Faber and Rubini. All right, they like to say things that are contrarian. Okay, so what happens that if you are just trading purely on such speculation, essentially you're trading what you're thinking and not what you're seeing, because what you're seeing is basically a chart like that. Okay, I mean this chart is not updated. This is from late 2015. Okay, but it's still slightly the same thing, except you see a bit more consolidation here right now, and it's moved higher from these levels. But the S&P has been trending higher, and it's still trending higher. Okay, even after the Brexit, even after the US shocker of elections, it's still trending higher to today. And that's where there's a big discourse with fundamental and technical analysis. And people who just trade based on their opinion on what they think is they're just trying to short. And I got a lot of clients trying to short all the way from 2013, 2014, 2015, and till today they're still bleeding. Okay, so it's a classic case of not following the sentiment. At the end of the day, no, we are traders. We are traders, and this is it's about sentiment, especially if you're looking at daily charts or even weekly charts. It's all about sentiment. So it's very important to know how to read the charts. Okay, because if you combine fundamental and technical, you'll be a much more effective trader. Let me give you some more examples. So for example, again, this is a Hang Seng 1 hour chart, right? So the Hang Seng 1 hour chart is on a uptrend. All right. So fundamental news, you got saying that the People's Bank of China allow cross-border sale of mutual funds. IMF mentioned that the Chinese yuan is no longer undervalued. So all this is actually good for the Hang Seng. All right, it's actually good because it means that more money is coming to the markets, more interest coming to the market. So it's actually good. But the question is whether you should buy now. Whether you should buy now based on the chart. So if you go to the daily chart, for example, you can see that there's a big resistance at around, this is the 25, right? Let me see, I can see the number. Around the 28,500 level. See the red line? So in terms of technical wise, it says that there's a big fat resistance there. Okay? But if you ignore technicals totally and you just trade based on the fundamental news that the PBOC is doing this and that, then what you will be doing is that you would be just buying exactly at the resistance. And not surprising after that, sorry, wrong slide, yeah. And not surprising after that, the market actually fell from here. Okay, so again, it's combining fundamentals and technicals. Yeah. Now, let me just give you one more example. So, your daily news that you see on things like your Forex calendars, all right? And sometimes news, again, it can come up to surprise. So you can see that this on 3rd February 2015, RBA cuts rates by minus by 0.25%, okay, or 25 basis points. And normally when the central bank cuts rates, what happened? The currency goes down, right? So on 3rd Feb, it did go down. However, subsequently on 5th May, where they did the same thing, the market reacted differently. Instead of going down, it went up. Okay, so all these examples, the reason why I put all these examples in front of you is because I just want you to understand what do I mean by trading what you see and not what you think. Because trust me, a lot of traders will always try to go against the markets, go against the charts and try to use their logic to justify their trading. So for example, in this case, right, if the RBA cuts interest rates and yet Aussie dollar is still going up, all right, their logical mind will come into the way and say that doesn't make sense. Economics 101 says that if a central bank cuts rates, the currency should go down. All right, so I'm going to keep shorting and shorting and shorting till the cows come home. Okay, it doesn't work like that. It's based on sentiment. All right, now you might ask me why. Why would the Aussie dollar go up instead of go down? My answer is I don't know. Okay, it really depends on how the markets want to react. Maybe this 76 support level is really strong, and some big hedge fund is buying a lot of Aussie dollar contracts around the 76 level. Maybe the Aussie dollar has been trending down for so long for the past few months, and maybe a lot of people are just taking profit here, regardless of what the news says. So when it takes profit, the currency tend to trend higher. All right, so there are many reasons, but again, it's about trading what you see, not just what you think. Okay. Now, the other good thing about trading what you see is this. Let me just try to get a blank screen here. So wait, hold on, yeah. So the other thing, let me use my beautiful IG template. Okay. So the other thing about trading what you see and not what you think is this. Now, we have what I call a predict cam. Oh my God, it's so hard to write using a mouse. Okay. And it's compared to a react camp. All right. Now, a predict camp, okay, a camp and CMP, or people who like to predict the markets. What they do is that they like to use their gut feeling to try to predict where the markets will go. And then they try to base it on some article that they read and things like that. So for example, I use the most recent one, like Donald Trump or the US election shocker, right, with Donald Trump won. A lot of people predict that the dollar yen will fall if Donald Trump won, and also most of the indices will just crash. All right, so these are the people who like to predict. All right, and people who react are people who wait to see how the market reacts, normally based on certain chart patterns or breakout before jumping into it. Okay, so if I draw a model here, okay, so imagine this is 0. Now, in the predict camp, let's say, this is just for example, ignore the current market movement. So let's say people predict that if Donald Trump won, okay, if Donald Trump won, the S&P will actually rally and break new highs. Just for example. So people predict that if Donald Trump won, okay, the market will rally and break new highs. So if that happens, right, then it's so awesome for them because they predicted here is 0 and the prediction came true at 100%. So they got the entire 100%. Fantastic. All right, they feel like, they're heroes because for them it's go big or go home. So for them it's 100%. Okay, whatever they predict happen. All right, so well done. But people who react, okay, instead of capturing the whole 0 to 100%, what they captured is maybe only 80%. Okay, and this 80%, why is it only 80%? Because the first 20% for people who wait, for the react camp, is that they're waiting for some kind of action to form in the charts. It can be a price action, maybe a higher high. It can be a breakout. Okay, so all this is waiting for technical setups to form before jumping in. So most probably they got in here and they got the 80%. Where else the predict people got in here and they got the 100%. Okay, now which one do you think is better, the predict or the react? What do you guys think? Most of you guys say react. Okay, it's not because I'm conducting this seminar that's why you choose react. Yeah. Okay. Yeah, exactly. Thanks, Eugene, for the answer. React because of high probability. Correct. That's one. But for me, the key thing why react is much better is because you can limit your risk. Okay, which to me is the most important factor. Okay, because risk trading is a lot about risk management. It's a lot about risk management. Okay, and for example, again, these predict guys are really happy if they predict that if Donald Trump wins, the S&P will shoot up and break new highs. Yes. Okay, but the question is, what if they're wrong? What if it went the other way around? Okay, and then instead of going 100, they'll be negative. Okay, and this is where the tricky part comes in, because when you are in negative, your psychology is much tougher to manage. And more often than not, a lot of traders, especially the newer ones, do not cut loss, and they will hold these negative losses for a long time, which number one will affect their psychology to take on other trades, and number two, it can lead to really bad circumstances like margin calls and things like that. Okay, and the question is, if you're in the predict camp, right, how many of such trades can you absorb before you go bust? How many? Okay, if maybe the first two you're so lucky that, whatever you predict came true and then you got 100%, fantastic. But how many can you absorb? How many negatives can you absorb before your account goes bust? Not many, isn't it? Whereas somebody who react, okay, you are limiting your risk because you are always waiting for the price to react first before jumping in. Now, can the price go opposite after you react? Of course. Okay, but what you are doing is that you are limiting your risk, and like what Eugene said, you are actually trading based on higher probability. Okay, I'm going to put it short form because it's painful to write on the mouse. Okay, higher probability. All right, you see my point? So reacting is much better, in my book especially, because you're waiting for confirmation. And it's very, very important to wait for confirmation in the charts, especially in the markets today, before jumping in. Okay, before jumping in. Yep. So let me just get rid of all this. Okay, any questions, please shout, yeah? Okay, so let me just bring up one live chart, for example. For those of you who are asking for some analysis on currency pairs, and I think one of you were asking about Asian Fed, I'll cover such things in the live market on Tuesdays. So next one is the next coming Tuesday. Yep, this one I'm going to stick to pure theory because there are a lot of people asking for it, so I just want to make sure that I give them what they want, and then in the live markets I'll cover a lot of charts and things like that. Okay, I mean for those who did the live webinar last Tuesday, there were two awesome trades that I hope you guys took, isn't it? I was saying the Aussie dollar short and the Euro yen long. Perfect setups, really, really nice trades. Okay, so where am I? Oh, yeah, so I just want to bring up the S&P chart. Okay, to just reiterate my point of trading what you see and not what you think. Okay, let me just delete some of the lines. Okay, so if you look at the S&P chart, okay, this is for the full year. This whole level here, this was Brexit. Okay, one June period. This whole long shadow here, this was the US elections. And you see how tricky it is? All right. So Brexit, right? I mean, a lot of analysts out there predicted that, you know, if the UK really came out of the EU, all hell will break loose, indices will fall from the sky, big market correction, blah, 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 blah. And the initial reaction was actually correct. It actually fell quite a bit. It fell the way from 2100 to about 2000 or so. But look at what happened. The whole move just reversed. Okay, the whole move just reversed. And if you look at this side here, this is the US election move. Same thing. A lot of analysts predicts that if Donald Trump wins, the market will crash, do a big correction because there's a lot of certainty, blah, blah. And you see the whole thing came down all the way to 2020. And then again, the whole thing just reversed. Okay, so again, if you're trading based on what you think, it's very painful to be in such times because the market is totally wacko. All right. I mean, if you get stopped out because the market irregularities, the way it moves, fine, fair enough. But really, the way the sentiment is just crazy. It's so hard to predict. It's really, really hard to predict. Okay. But for those of you who are on the react camp, maybe you might have got stopped out based on the initial drop. Okay. But if you see that the market is making higher high, okay, number one, you're smart enough not to carry on shorting. Number two, you most probably will be looking for longs. Okay, and that's how the people in the react can benefit because they're waiting for price to show them. Can they be wrong? Yes, they can be wrong, but they are alert to know to see what price is showing them. Right now, price is making a new high. Okay, so that's how the S&P for just this year, just crazy markets this year. All right, so let me just move my live charts back. So at the end of the day, okay, important to remember yourself that you are a trader. You're not just an analyst or economist. Okay, you know what the joke they say about an economist? And any of you know the joke about what people say about economists? So they say that an economist is an expert who will only know tomorrow why the things he predicted yesterday didn't happen today. Okay, so an economist is an expert who will know tomorrow why the things he predicted yesterday didn't happen today. Yeah, so we all are traders. We're not economists, so it's very important to trade what we see and not what we think. You know, the worst thing is that a lot of this thing called confirmation bias. Okay, and you guys heard what confirmation bias is? There's a whole psychology topic about it. whereby a lot of people like to pick up information and pick up things to read just to confirm what they think. And that's scary. That's scary because if you, oh, Jingyi, you're here. So my market strategist is attending my webinar. I didn't know that. I'm sorry. um, the code is not by me anyway. It's just a joke. But yeah, what I'm saying is that where was I? See, you made me lost my train of thought. I really lost my train of thought. Okay, never mind. So, oh yeah, confirmation bias. So we're just talking about confirmation bias, right? And so confirmation bias is where, you know, many times whereby, let's say if you think that the S&P is going to fall, and you know, the market is going to crash, more often than not, we tend to read articles that say the same thing. And the amount, the wealth of information out there, you know, some saying the markets will fall, some say rally. There's so much information, so much news out there that you can pick to suit what you want. And that's even more dangerous, okay? So what I'm trying to cover today is I want to cover how you can use the chart to help you to make decision, okay? And this little quote that I have here, it's more important to know when to buy and sell than why the S&P went up and down. Okay, I repeat. It is more important to know when to buy and sell than why the S&P went up and down. You get what I mean? So why is good to know, but when for me is more important. Okay, because this is where you want to make money as a trader, isn't it? So that's where you need to plan your trades. Okay, so let me just go to the theory part of things. All right, let me just introduce to you something that called price action. Okay, if you Google price action, there are books about it as well. It's basically just knowing how to read price in the purest of form. All right, there's no indicators. For me, it's more of a leading indicator than lagging indicator. All right, and that's why I love price action, because you can roughly tell whether the market is an uptrend, downtrend, or sideways. Yep, and price action involves support and resistance, chart structure, and trends, which I'll cover much more. Okay, let me just skip some slides. Okay, the first thing about price action is you need to understand how to identify swings. Okay, so swings in the markets are basically levels whereby they form concave or convex areas that is more often than not coincide with key support and resistance levels. So if you see the circles I draw here, these are called swings in the market. Okay, and you notice the chart is a naked chart. It's just a pure naked chart, just candlestick. You can use bar chart as well. Okay, but you notice the circles I draw, they're convex or concave shape, or can be a straight as well. But you see, they always coincide with key support and resistance levels. Okay, it can be 2 candles, 3 candles, 5 candles, depends on the level. So for example, if you see this here, you can see that this swing here, let me just take out my pen. This swing here contains almost how many? 1, 2, 3, 4, 5, 6 candles. It's considered a swing because it's at the key level as well. This one here is contained about 3 to 4 candles. Okay, this one here, about 3 candles. Okay, so this is how you identify swing. It's a bit discretionary, I agree. Okay, but if you look at the charts long enough, you will be able to identify a swing clearly. Yep, and swings can be identified on any time frames. Obviously, the higher time frames is more respected because it's a longer term time frame, but there are always swings in the markets in terms of identifying it. So the next question, okay, let me see, put my pen away first. Okay, so the next question is, why do you need to identify swings? Okay, you identify swings because you want to label it. Okay, and there are 4 things that you can label. Basically, a higher high. Let me just write this now. A higher high, lower low, a higher low, and a lower high. Okay, 1, 2, 3, 4. So 4 things that you can label. Okay, you identify swings so that you can label them any of these 4. And basically, once you label them, you are able to tell whether the market is trending or downtrend or things like that. And it's much easier if you know what the market is trying to do, so that you know whether to plan and trade, to avoid it, you know. And this is basically what you do after you put swings. So for example, if you have this little chart here, so if you see this swing here compared to this swing, is actually called a high low. You see that? So you always compare to the one swing below. So this swing compared to this swing is another high low. Okay, now this whole swing here compared to this previous swing is a high high. See here? And this swing here compared to this swing is another high high. So you can notice that from here onwards the market is on a uptrend. See that? It's an uptrend. Actually, you can compare this swing here and this swing is also a higher low. Okay, and this one compared to this one is almost the same low, but it's still considered uptrend. Okay, so just you get a hang of it once you do it more often. All right, so moving on, let me just take my pen away. You guys, again, if you guys got any questions, just feel free to shoot. Is this webinar recorded? Yes, it is. It's recorded and be uploaded to our website. Yeah, I mean, I put it as 1.5 hours because I have a lot of things to cover. But if you get bored of my voice, yeah, feel free to watch the recording. I know my tolerance for webinars, for other people's webinars, is only half an hour, and then my concentration levels will just go down. Okay, so once you identify swings, right, and basically you can put the market in 3 different phases. You got uptrend, which is a series of high lows. You got a downtrend, which is a series of lower high, lower lows, and you got consolidation. Now, consolidation is a bit more like your chart patterns. It can be a channel, a wedge, for this example, head and shoulders, triangle, whatever consolidation. Yeah. So this is a very key point. Is basically you want to identify swings so that you know which phase the market is in. Okay. Then from there you can start planning your trade the way you want it. All right. So some examples. Hold on, let me see whether I can jump here. Okay. Okay, some examples of trending charts. You can see that it doesn't matter what instrument is this, but basically you can see that all the circles are the swings, and basically you can see that it's a combination of high lows, high lows. Okay, now can anybody tell me which market is doing something like this right now? You bet it looks very similar. Dow Jones. Every market. Yes, Raju, Euro Yen. This was looking for the yen pairs. Dow Jones, yeah, Dow Jones is not too bad, but the thing about Dow Jones is it's not making new highs. So yeah, I prefer S&P. Correct. Okay, good point. So Michael. So yeah, most of the yen pairs are doing exactly the same thing like that. Okay. The S&P is broken new high, but it's not really make higher lows. Just keep it going higher and higher and higher. Okay. Okay, Michael, you have a question. How long does one trend or swing last? Good question. It depends, Michael, which I'll cover later in the webinar, because I will cover multiple time frame. So how long does a trend last depend on the time frame. Okay, a weekly trend can last for months. A 1 minute chart trend can only last for 5 minutes, or maybe, I don't know, maximum. I mean, there's no maximum, but a 1 minute trend is a very short period of time. It can turn anytime. All right, so it depends on time frame. Yep. Later I'll cover how to combine multiple time frame, not to worry. Alex, at which point should we stop the trade and take profit? Good question. I'll cover it in a while. So give you about 5-10 minutes. Okay, but basically I just want you to be able to identify trends, okay, and identify what phase the market is in first. Okay, some more examples. This is another chart whereby just seeing a series of lower highs. You know, I mean, on a PowerPoint slide, it looks so nice, isn't it? If only every markets look like that. Okay, when I presented, one of the trader came up and asked and told me that how often can you find markets like that? Okay, my answer to him is you can. Not every day, but you still can. Okay, because the way I trade the markets is I just don't focus on one particular instrument. Okay, there are so many markets for me to look out for, from sugar to soya bean to gold to euro dollar to Aussie yen to pound cat to S&P to DAX to Nikkei. The only thing I'm not looking at is stocks, but it's definitely something I want to look out for as well. But basically the key thing is that, because when you're trading price action and things like that, right, you want to find the market that's the most fluid. Fluid means the movement is the most obvious. Okay, so if you can find charts like that all the time, your probability of profitability, right, or your probability of having a good trade is very, very high. Okay, because everybody's saying the same thing, the momentum is there, and the trend is just continue. We just continue. Okay, Raymond, you asked euro dollar is a downtrend. Again, sorry, man, I'm not covering. You're talking about the euro dollar as an example, or you want me to cover euro dollar? Because I'm not covering live markets today. Okay, but I mean, if you can find charts like that all the time, it'll be really, really good. Okay, really, really good. Which is why I'm thinking of introducing US stocks into my portfolio as well to see whether I can, because there's so many US stocks that's amazing. Oh, for those of you that like US stocks, right, and want to look for trends, my market strategist is doing this Momo report. Her name is Jingyi. She's in this webinar now as well. So she does thing called the Momo report, called the Momentum report. Okay, I really like it because what it does is that she will filter all the markets and scan all the US stocks in the S&P 500 to see which one has broken up from key level based on news and technical levels. Okay, so if you like to trade, you like to look for trending stocks in the S&P, look out for the Momo report. You can subscribe it on the IG website. Okay. Raymond, oh yeah, sorry Raymond, you say euro dollars is a downtrend example. Yeah, you're right. Yeah, sorry about that. I thought you were asking for live market. So euro dollars is a good example for downtrend as well. Yep. Cha, good question. Cha said, what if I see downtrend the daily chart but uptrend the 4-hour chart? Perfect question, which I'll cover in a bit. Okay. Seems a lot of you know quite a bit, so I'll go a bit faster. All right, so this is another example: high, 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 low, blah, blah. Okay. Okay, examples of non-trending charts. So you can see charts like that. And more often than not, when the market is non-trending, the reason why I say non-trending is, for example, it is not a consecutive higher high, higher low, higher high, higher low, or it's not consecutive lower low, low high, lower low, low high. Okay, it's just really, really mixed. For example, this case. Okay, for example, this case, you can see that. Where is it? Okay, you can see that a lower low is here. A lower low has been made from here, but then after that it made a higher high. You see that? And then it made another lower low. So it's really mixed. So when it's mixed, right, just be prepared to take out your drawing tool and look out for some chart pattern that might be forming. Okay, so examples non-trending charts whereby they are sideways. Some of you like to trade sideways patterns, some don't. It's really up to you. Okay. Now, what I don't like to trade are charts like that. Okay, especially this one. I don't know what chart this is, but if you can see that it's really, really messy with no proper price action, I totally avoid. Okay, because there's no clear direction. If I can't see anything, a lot of traders can't see anything, momentum is not there, why would I want to get involved? Nada. Okay, so don't like it. So just to have a quick summary, so if you look at price action in terms of uptrends and downtrends, on the left-hand side is all the uptrend scenario, on the right-hand side is all the downtrend scenario. Okay, which I'll cover a bit more detail after this. Okay, so basically for you see the uptrend, you can see double bottom, breakout, high, 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 low, go up. This is high, 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 low combination. This is a chart pattern breakout. And this is a low, low followed by high, high combination. So same thing for short. Okay, I call this my cheat sheet. I've been using the cheat sheet for the past 5 years. And basically it's just to give me a gauge on what the market is doing. Now, will the markets look exactly the same? Of course not. Okay, this is just theory. It looks very nice here, but the market sometimes does not look exactly the same. It can be quite tricky. Okay, but at least you need theory to guide you. Okay, I've got some questions. Can you repeat the iTunes app you just mentioned? Sorry, Peter, I didn't catch you. What do you mean? Did I mention any iTunes app? When would you, okay, Brian has a question. When would you enter a sell on lower high? Okay, I'll cover that as well. But the later part where I show you how to combine all the different indicators and things like that. Yeah, John, good point. When the market is non-trending, you might want to go one time frame higher. Okay, that one I'll cover a bit more when I talk about time frame, multiple time frame. Okay, so any questions? First, with regards to identifying trends. So 3 phases, okay? So the first part of the webinar is done. I just want to make sure that you are familiar in identifying these 3 phases. Any questions? If you have any questions, You can ask now, forever hold your peace. Okay, if not, I'll just move on to the next part. Okay, very important. Yeah, this part is very important. You need to know very well before I move on next. If not, you'll get confused. And then tonight you'll be dreaming of all the high, high, low, 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 high, low, low, and things like that. All right, so no questions. Let me move on to the second part now. Okay, second part is called changing on trends. When will the market change or trend? Yeah, and if you manage to catch a change of trend in a higher term time frame, it's actually very rewarding. I think one example was the Aussie dollar that I mentioned about during my last webinar on the 15th of November. Okay, you can go back to the recording and have a look. I actually spotted a lower low on the daily chart, and it was making a lower high, and good enough, it actually fell for the next week or so. Okay, so that's where I identified a change of trend at the beginning on a higher time frame chart. There's a lot of meat there to be able to trade. Okay, so change of trend is basically offer the best risk to reward as compared to catching a falling knife and stepping in front of a raging bull. And basically it gives you, it teaches you to be patient to wait for a trend to confirm before pulling the trigger. Okay, but what is change of trend? Okay, there are two types of change of trend. One is a strong indication, and the other one is a not a strong indication. Okay, so let me talk about strong indication first. Now, two things that you need to know for a change of trend. First thing is a higher high. Second thing is a lower low. That's it. These are two main things you need to know for a change of trend. So for example, you can see a downtrend. See here the market is moving, suddenly boom, lower low. Okay, so lower low is the first sign that the market is going to a downtrend. All right. How about uptrend? The first sign when a higher high is made. Okay, again, when you compare swings, you're only comparing to the swing before. You're not comparing to the swing 2 or 3 swings before, just the immediate swing. Okay, you're comparing to the immediate swing. So when a higher high is made, okay, most probably it will be an uptrend, a change of trend to upside. See, same thing here. This one compared to this one is a lower low, and then is a sign that is coming down. Okay, so a strong indication is basically looking for higher highs and lower lows. All right. Scenario number 2. Okay, scenario number 2. Let me just take over the drawings. Okay, scenario number 2, two things, lower highs and higher lows. Yep. And you can see here that it came down, it formed a lower high. It's the first sign that it wants to drop. Same thing here. See, it hit the bottom, it formed a higher low. It's the first sign that it wants to go up. And then it's on the uptrend, and then it made a lower high against the first sign that it wanted to drop, and it did drop. Okay, so this is not as strong an indication as the previous one, but it's still a indication that the trend might change. It might change. All right, so let me give you an example. Let me just draw you an example. Okay, so what you can do is to get the hang of all this change of trend and things like that, right? You go to your charts. I like to use an MT4 chart previously when I'm learning price action, and basically there's this F11 shortcut on the keyboard, whereby if you keep pressing F11, the chart will just move slowly as if the market is live. Okay, you can do it over the weekends. And what you're trying to do is that you can pull back the charts to whichever year and then keep pressing F11. And then what you're trying to do is you keep trying to identify a change of trend and see whether you identify it correctly. So what happens, for example, the market is moving high, 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 low, high, 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 low, and then suddenly it forms a lower high. See? So lower high is an indication that the market might change, correct? It might change to either a complete downtrend, or another scenario is that, again, lower high, the market might start consolidating into some kind of chart pattern. Okay, but a lower high is a sign. All right. Same thing for higher lows. So the market is coming down. Okay, it's the first sign that the trend wants to change. Either it will form some kind of chart pattern here before moving up, or it will just form a higher high and start moving up like that. Okay, so this is just a weaker indication, but it's also a indication that the market is changing. So let me just bring out a chart for example. So this was Aussie dollar here. Okay, see the arrow here? This was where I mentioned it during the webinar. I said this area would be a decent short. I'm not sure whether you guys received the trade ideas that my marketing team sent out every now and then. Basically, I do the trade ideas before a webinar, and I try to send it out so that I can cover it during the trade webinar on Tuesdays. So this was one of the trade ideas about Aussie dollar, and the reason why I thought this was quite a decent setup is because you see all the swings here. Okay, and this level is quite key to me, the 75.80, because of this support here, resistance here. I'm not going to cover support and resistance here. I think it's very basic. All right, so I think most of you should be very familiar with support and resistance. But basically, what happens is that it forms some kind of a double top here. Okay, and then this swing here, compared to the previous swing, is a lower low. Okay, later I'll show you how to enter, but basically this swing compared to this swing here is a lower low, which is a sign that the market is turning. And it's also further emphasized by the fact that it's broken this key trend line here. See this trend line? So this trend line is beautiful, and then it just came down. All right, so there are multiple levels why this was a nice change of trend. All right, break up trend line, lower low. The key thing that I want you to know is the lower low. Okay, it's the lower low. Yep. Now let me give you an example based on this chart. You can pull up many examples on the live charts. Okay, so look at this here. See, the market is coming down, right? So this is actually a downtrend, isn't it? Now what happened here? This is a low, and then what I did here? What's this called? Any of you know what's this called? This swing here? Lower high. Nope, not lower high. This swing here. This little swing here compared to this swing. Exactly, Cynthia. Higher low. Okay, and you see it forms a higher low. It's the first sign that the downtrend has ended. In fact, if you are good at chart patterns, this is what you call a inverse head and shoulders, isn't it? And this is a neckline. And when you broke the neckline, what happened? You just keep going higher, higher. Okay, so if you see, I can just pull out any live chart and show you gazillion examples. Okay, but the challenge for you is to be able to identify it at the live markets. Hindsight is always easier. Okay, but you can see that after you identify the high low here, right? The market keep trending up. Okay, and the key thing is this. The market was trending up, right? And at every point in time, the market is always making higher lows. Okay, so fair enough, this one is a similar low, but still not broken. Okay, and higher low. Now, where was the first time that it made a lower low? Look at this. Compared to this. Okay, I'm going to compare this one. Okay, this is a lower low. In fact, it gave you a sign here as well. Got this one compared to this one. Lower high. And then what happened? Bam, went down. You see that? So it gave you two signs here. Form a lower high first, and then it formed a lower low. And then it started coming down. You see that? So again, you can just pull out any random live charts and you can see price action is very best. Yep. But you need to be able to keep the challenge to be able to identify it on the live markets. Alright, same thing here. Look at this. Downtrend, this was a low. Okay, it formed a higher low here. Okay, and then it's confirmed because this one compared to this one is a higher high. Okay, and then it formed another low here, which is a similar low, and then it continue upwards. You see that? So price action is very powerful. It's actually a leading indicator. Now, where we are right now, okay, it's basically might be a start of a downtrend already. You got lower low, lower high, lower low, lower high, so it might start falling further. Okay, maybe back to previous low, around 73 cents or so. Okay, so I just thought to pull out a live chart to give you an example. But you guys have any questions? Oh, Victor, that time frame is a daily chart. Fuguan, what is a swing? Oh, a swing, I mentioned in the beginning of the webinar, Fuguan. A swing is basically like a area on a chart whereby it's formed like a concave or convex shape. So for example, these are all swings. Okay, go back to the recording and watch the beginning. So these are all swings. Okay, normally it coincides with key support and resistance level, but normally it forms a kind of concave or convex shape. Okay, these are all swings. These are all swings. Swings, 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 swings. Okay. All these are all swing. This is a swing, this is a swing, and most probably a form another swing here. Okay. Any questions? Does this apply to any time frame? 100%. 100%. So this is an Aussie dollar daily chart, right? You want I can show you a 5-minute chart. Okay, so you see 5-minute chart. You can draw some kind of consolidation here. See, not much price action happening here. Higher high compared to this. Remember the change of trend, higher high and higher low, higher high, higher low. And then now it's a bit tight because it's forming a lower high already. See, so this is the first change of trend, higher high here. And then continue up. Okay, but now it's forming a lower high. Compared to this is a sign that the uptrend is tight and indeed it's forming a lower low. So you're always comparing to the swing previous, the first previous swing, sorry. Okay. Brian, is it a 5-candle pattern? Like I said, it can be 5 candles, can be 3 candles, can be 2 candles, can be 6 candles. It depends on the levels. So for example, this whole I identify this whole area as a swing. These are how many candles? Because for me, this is a whole resistance level I'm looking at. Well, this one is only like 4 candles. This one's only 2 candles. This one's only like 1.5 candles. You get me? Okay, any questions? This is very important because you need to be very well versed at this before we move on. I get more confused. Okay, so what I have covered for the last 5-10 minutes or so is basically identifying change or trends. Okay, let me give you more examples. Okay, this one's a bit tricky. So again, I'll go back to theory. Sorry. So a change or trend can either happen when a higher high or lower low has been formed. That's a stronger indication, or a higher low or lower high. Okay, but this is a weaker indication, which means that it might not be a reversal, it might just be consolidation as well. You got it? TC chart, sorry, for this trend analysis, time frame to daily chart apply to stocks, FX, future, or different time frame for different things. It applies to any time frame as long as there's a price, as long as it's a chart, you can use it. Okay, as long as it's a chart, you can use same thing. But how long you want to keep the trade, that's where the time frame comes in. If it's a daily chart, like the Aussie dollar trade that I mentioned, if it's a daily chart, maybe you're keeping the trade for a couple of days even. Okay, but if you're talking about a 5-minute chart, then most probably you hold your trade like the most 1-2 hours. All right. Okay, any questions or change of trend? Let me move on to some examples on the PowerPoint slides. Okay, so you can see that the examples of trend changing are this. This is a significant higher high. It broke up on consolidation, and even nicer because there were so many high lows formed here. Okay, so this is a very beautiful one. Same thing here. See on the right? Really nice higher high, breaking through all these previous highs, and then high lows, and then it went up again. Okay, another example. Okay, you can see this one here. It was consolidating, lower low, lower high, and then the downtrend continued. Okay, let's see another example. Okay, this example, you can see this very strong downtrend. Okay, you actually form a double bottom here. Okay, followed by a higher low. Okay, but you see that a high low might not be a change of trend, because if a change of trend happens, right, if you're going to uptrend, you need to form a higher high, but actually you form a lower high first. So it actually consolidated a bit before you form a higher high to confirm the change of trend. Alright, but this high low gives you indication that the downtrend is a bit tired already. You get what I mean? Okay. Alright, any questions so far? Okay, no questions. Let me just do a quick recap. I can ask you some questions. Okay, ask me as many questions as you want, because this is to make full use of the webinar. Okay, so for example, now just one thing to note, that if the market is trending higher, 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 high, low, higher, high, sometimes it won't be so beautiful, higher, higher, low. Sometimes it can form something like that, then it continue upwards. Okay, but for this kind of case, right, the key thing is, as long as no new, so this is uptrend, right? This is definitely uptrend. But as long as no new lower low is made, right, the trend is still intact. If this swing breaks below this swing, then maybe maybe the trend's ending. Okay, but as long as there's no new lower low made, the uptrend is still intact. Okay, the uptrend is definitely still intact. All right. Same thing for downtrend. Same thing for downtrends. Coming down. Sometimes it will form some kind of double top, and then it comes down again. So sometimes you see, yep, lower low, lower high, lower low, lower high, and then this one is actually a higher low. So some of you might say that, hey, higher low. Okay, so higher low means that there might be a change on trend, might be, but it's not a strong indication. Okay, but it made a lower high. Okay, and then it fell further down. So a higher low might seem that there might be just a pause, but that does not mean that the trend is changing yet. Okay. Yes, Sunil, I'll be talking about how to enter as well. All right, any questions? You guys have any questions? Okay, now I'll move on to how to enter the trade. Okay, but firstly, number one, you need to be very well versed on identifying uptrend, downtrend, or sideways. That's number one. Number two, you need to be well versed in identifying what is a change or trend. And number three, which I'm going on now, is I'm going to show you how to enter the trade. Let's see. Okay, entering the trade, these are the rules. So for example, if you're on an uptrend, okay, and you identify that it's bullish, you are looking for a high-low level to buy, you're looking for support to buy, and you're looking for resistance to exit. All right, so your profit target will be resistance. If you identify the market is in downtrend and you're bearish, you're looking for a lower high to sell, looking for resistance to sell, and you're looking for support to exit. Okay, so if I show you this cheat sheet that I showed you just now, so basically on the left side is all the potential long scenarios, the right side is all the potential short scenarios. Yep, so you can see that the long side, the market is going up, high, low, you buy. So you always buy at high, low levels. Okay, so some clients, they are good at identifying trends. So they say, okay, nice, market is going uptrend. But they're so eager to buy that they buy somewhere here. And the problem is buying here is that you're buying at a higher high. And if you buy at a higher high, the question is, where's your stop loss? Okay, it's very hard to gauge your stop loss as compared to somebody who's waiting for high low. Okay, and then he buys it here, and at least the stop loss can be below the previous swing. You see that? But if you buy at a higher high, it can be a nightmare to manage, because if the market starts coming down, the trend is still up. Okay, so your analysis is still correct, it's still bullish, but the question is, you are on a negative position already. Okay, it's very painful to wait for it to retrace, and then wait for it to do its thing before maybe it comes back up, or might not. Okay, so the entry for long trades are always looking for high lows and support. The entry for short trades is always looking for lower highs to short as well as resistance levels. Okay, so let me show you an example of live chart. Mr. Chang, great question. Okay, Mr. Chang is saying that how will you know that it's going to be a high low? That's where you okay, that's a very good question. Okay, of course, on hindsight is easy, but that's where you combine your support and resistance and your whatever indicators. Okay, let me show you in live charts. So back to the Aussie dollar example which I showed you. Go back to the daily chart. Okay. Now, just now I explained to you why I identified that there's a change of trend here, isn't it? Okay, because of this lower low identified. Okay, so obviously now hindsight, okay, it's easy to tell, but why is it that I was able to tell that, I was able to put my red arrow there and so-called see where the potential higher low lower high might be to short? So basically, I already identified the downtrend. Okay, what I'm trying to do is I'm trying to look for this lower high to short. Okay, and the reason why I say anywhere around 75.80 to 76, okay, you can look at the email that was sent out 2 weeks ago, is because of this resistance level here. Okay, you can see that this was resistance, this 75.80 level of resistance here, support, support, resistance, support, support, and potential resistance. Okay, and you can see that this respected to the pip before falling down. Really beautiful. That's like a 300 pip move. Okay, so this was a very, very nice move on the Aussie dollar chart. So how do you know whether it's a high low or lower high level to get in? Combine it with your support or resistance. Okay. Okay, the other question you have is how will you know it's going to be a high low? Okay, answer that. The question is cause you wait for the completion of the next candle. Okay, that's where I'll address it in the next section based on multiple time frames. So the first thing is this: I identified that the market has formed a lower low. It means my bias was bearish. Okay, I entered the trade based on the lower high, so I was looking at lower high resistance to short, right? So I was looking around 75.80 to 76. Okay, now what happens that when the market came to this area, I switched my time frame here to a lower term time frame, maybe a 1 hour and 15-minute chart to wait for confirmation. Okay, so my bias is set based on daily chart, and then I switch to a lower time frame to confirm, which I'll cover right now, how to use multiple time frames. Okay, thanks for the question, Mr. Chiang. Oh, another question. Okay, based on this example, your stop loss. Okay, my stop loss is definitely not here. No way, way too far. Okay, my stop loss is based on the lower time frame chart, which I'll cover right now. Okay. Now let me just erase all these drawings and go back to the PowerPoint slides. All right. So any questions based on entries? Sunil, are you clear on this? Since you're asking about it. Yeah, the multiple time frames are covered just after this, not to worry. Okay, any questions on how to enter? So again, number one, I showed you how to identify swings, how you tell whether the market is an uptrend, downtrend, or sideways. Second part, I explained how to identify change or trends. And third, I showed how you can enter the markets, enter the trades. Hi, Joe. What about breakout? Same thing, Joe. You see breakout? See my last two example? So left side is for longs, right side is for short. Those are breakouts. For this is a breakout of a wedge, can be a channel, can be head, shoulders, same thing. Because essentially a breakout, right, is a change of trend. So you can see that a breakout you see here, this is actually a lower low. And this one here is actually a higher high. So it's actually a change of trend. Yep. Sunil, your trading bias is always a daily chart. Yeah, it's always based on daily and 4-hour chart. I try to keep it as simple as possible. Okay, any questions? Now move on to multiple time frame. For entry, you enter the market or buy. If I'm in front of the markets, I enter the market. If not, I put an order. But orders, you got to be very careful. Make sure that you're not close to news releases. Yeah, I prefer to enter the market. Yeah. What if there's a divergence in the 4 hours in daily? Then I'll avoid the trade. Yeah, if there's two different things, I'll avoid the trade. Okay. Okay, I'll cover the multiple time frames right now because most of the questions are talking about multiple time frames. Okay, so now let's talk about multiple time frames. So multiple time frames can be quite tricky. Give me a moment. Let me just drink some water. Okay, sorry. So multiple time frames are a bit more tricky because different time frames tell a different story altogether. Okay, so if you look at this is a China index CSI 300. If you look at the 5-minute chart, it's sideways. Looks a bit like heartbeat monitor, right? If you look at the daily chart, it's uptrend. If you look at the 2-hour chart, it's almost a downtrend already. Okay, so it's very subjective based on time frame. Same thing here, Aussie dollar. 5-minute uptrend, daily uptrend, 1 hour downtrend. Okay, so the key thing about multiple time frame analysis is very, very important that you must always see the big picture. And the big picture when it comes to trading is the high term time frames, because the high term time frames are definitely more expected. And you want to know what's happening up ahead, okay, before zooming in and taking the trade on a small term time frame, right? So you can compare the clear skies as compared to a foggy environment where you can't see what's in front of you. Okay, so to answer your question, Sunil, I mean, I like to use high-term time frames like daily and 4-hour to form my bias first, because I want to know what's ahead, what's the direction, and then I zoom into low-term time frame to take the trade. All right, but to explain multiple time frame analysis now, if you look at the yellow arrow, this is like a daily chart. So daily chart can be very straightforward. Okay, the daily chart can be showing a nice uptrend because essentially you just focus on the yellow arrows, right? Essentially it's just a higher low, higher high. So for the yellow arrows, right, it's very straightforward uptrend. But then you zoom in a 4-hour chart. You notice that the 4-hour chart, within this big uptrend, there are little uptrends here. And then little downtrends and little uptrends. And if you zoom in even further on the 15-minute chart, you can see that the 15-minute chart is making a lot of trends in between a bigger uptrend on the daily chart. Okay, so basically, an excellent long or excellent short is where 3 different time frames are saying the same thing. Case in point, your yen pairs right now, all right, all trending very nicely. Aussie dollar as well, trending very nicely. Because all different time frames are saying the same thing. Okay, so as a trader, if you're able to find such a trend, you can just ride on a trend based on the lower term time frame. All right. Okay, let me see. So but the reason why it's so important to see a higher term time frame as a reference point is because sometimes, right, after you enter a trade, all right, and you take a step back, and you realize that, oh my God, you were so cooped up in the lower term time frame, but actually the higher term time frame is so clear. Any of you felt like that before? So the long-term chart seems so clear. See, just nice downtrend. Okay, but because you were so obsessed or so involved in these little swings here, all right, you probably make 2, 3, 4 losses here, and it just messes you up. And then when you get messed up, when you take a break, when you come back to the charts, you see the market actually falling further, and it's very irritating. Any of you experienced this before? See, so yeah, and that's the reason why it's so important to focus on the long-term charts first, to give you a guide, to give you a time frame. So back to that picture, you see the clear skies versus the foggy skies. So sometimes, right, it happens to me as well. Sometimes, let's say if I see the market on the higher time frame, the daily chart is downtrend, and I try to short many times. Like I think this week, Pound Cat daily was an uptrend. 4-hour chart was sideways. So I tried to take 1 or 2 longs, and I got stopped up. Okay, but the key thing as a trader is that you need to be confident in your strategy of your analysis, and if you are clear that the higher term time frame is still telling the same story, do not be afraid to pull the trigger again when the lower time frame shows itself. My trading, the stage of my trading right now is I'm trying to reduce my losses and just take good quality trades. So every time when let's say for this example, right, if I identify that the higher term time frame is bearish, all right, I want to make sure that the lower term time frame is showing that it's turning down as well, then I enter. Okay, I try not to be too gung-ho and just jump in here and there, because 2 or 3 losses here can really affect your confidence, and you'll be like, what the hell, you know? And then if the frustrating thing is that if your analysis is correct but you're not in the trade, happens all the time, isn't it? So be always multiple time frames, it's always good to look at the higher term time frame just to reference to see whether the trade is still there. Easier said than done, trust me, because a lot of time psychology is a very tricky thing, and that's where we get mucked around in this little short-term charts here. Okay. Joe, your question is what size stop loss you use? Okay, I'll cover that in a bit. All right. So basically, for multiple time frame, you can use this guideline. If you're a scalper, you can use a 15-minute to form a bias, 5-minute and 1-minute to plan a trade. Intraday, 4-hour, 1-hour, 15-minute. This is not a black and white thing. It's just my own guide. All right. You can look. Ideally, normally I look at 4 different time frames. Okay. So for intraday, normally I put daily in front as well. This is just a rough guide. Okay. Swing, meaning you keep your trades for a couple of days. You can use weekly, daily, 4-hour. Position trading, can use monthly, weekly, and daily to enter. Okay, this is a rough guide for you. But basically, you need to understand what kind of trader you are, which time frame are you focusing on, and very important, what's your expectations. Okay, I used to have a problem whereby I like to use daily charts to identify a trend, but I don't have the patience to wait for a daily chart to set a price target on a daily chart, because it takes too many days. So if you feel that you're that kind of trader, then you might want to go to lower term time frame. Okay, it's based on expectation, based on personality, a lot of factors, but you need to know what kind of trader you are. All right, and it also is a bit more conservative, because a lot of times my stop loss can be based on shorter term time frame charts, so that I'm more conservative my risk, but my profit targets can be based on the higher term or longer term charts. Okay, so if you look at back to the Aussie dollar example. Okay, I think one of you are asking, okay, this was lower high. Now, where's my stop loss? My stop loss is definitely not going all the way here. It's crazy. That's about 200-300 pips. Okay, but how I entered? Okay, so bear this in mind. This is 75.80 level on 15 November. Okay, let me go to the 1 hour chart. 17,580 here. Okay. What was this? 5. When was that? 17? No. Sorry, I lost the date again. When is it? 15 November. Okay. Yep, this one here. Okay, so this is a 4 hour chart. Let me go to 1 hour chart. 15 November. Okay, found it. Okay, so you see this whole level here? This is basically that retracement lower high on the daily chart. Okay, so again, once we are here, okay, if you don't look at the higher time frame, trust me, you'll be totally mucked around here. But because I'm very clear that my daily time frame shows a lower low, I'm very clear that I'm bearish, I'm very clear that I want to short, I'm very clear that this 75.80 is a lower high resistance area. I'm just waiting for a lower term time frame to confirm. Now, even though I said 75.80 is a key level to short, alright, a lot of you might ask, will I just take a short here when it hits 75.80? My answer is no. Okay, because what I like to do is for it to confirm first. And for this case, the 1 hour has been relatively sideways. Okay, some of you might say that this was a little resistance area. Why can't I take some shots here? Or here? Or even here? You can. It's a bit more aggressive. Okay, but for me, I prefer to wait for the lower term time frame to show itself first. Okay, so what I did was, oops, sorry. Okay, so what I did is I was waiting for this whole support level to be broken first. Then I enter. So my entry was actually this little pullback here. Okay, and then I just ride it along. Okay, and my stop loss was back to above this previous area, because for me, if it totally retraces back, let me just clear some of the lines. Okay, so my entry was this little pullback here, stop loss just above here. So this was like, how many pips is that? 75, 24, that's about 30 pips stop loss. Okay, but essentially my profit target can be based on a daily chart. Okay, so basically, why my stop loss here? Because if it breaks down and reverses back totally, that means that this breakout is a false breakout already. You see that? Okay, so this is how I wait for the lower term time frame to confirm, and how I combine different time frame analysis to the trading. All right. Okay, so, oops, sorry. Any questions so far? Okay, there's no questions. I'm gonna move on to some few more examples. So what I've shown you so far is basically, again, number one, how to identify trends based on price action. Okay. Number two, how to identify change of trends. Number three, how to identify or how to plan a trade or using multiple time frames. Okay. And lastly, how you put them together and plan a trade. Okay, if you are used to moving average or you're using divergence, pivot points, by all means stick to that. In fact, I use all those as well. Candlestick patterns, I use all those as well. But what I'm covering in this webinar is the backbone of my technical analysis. Okay, especially because you notice that price action, support and resistance, multiple time frame, all these are sort of so-called leading indicators. And I much prefer leading indicators. The lagging indicators is there to help me confirm certain levels before I pull the trigger. Okay. Sunil, you enter before the close of the pullback candle with a fixed stop loss. Yes, before the close, but based on lower term time frame. Correct. With a fixed stop loss, yes. The stop loss normally is if I'm shorting is the previous high, if I'm buying is the previous low. But it's based on lower term time frame. Can be 1 hour, can be 15 minutes. Okay. So just covered the trading process. So again, I form my buyers based on the high term time frames. Okay, so for my case, it's the daily chart, whether I'm bullish or bearish. And then that's where I plan the trade. The bias is very important because if your bias is not strong, if you start playing the trade and you start going to lower term time frame, what happens is that if the market gets very volatile, you get so sucked in, you forgot what's your bias and you try to go against it. Okay, that's a big no-no. Okay, you want to plan the trade based on your bias, your firm bias, and then that's why you stack the odds. And when you stack the odds, that's where you can use different factors like multiple time frames, support and resistance, chart patterns, whatever in MACD, whatever indicators that you like. Okay, but basically just to confirm your bias. And once your lower term time frame confirm your bias, you enter the trade. That's where comes in your trade management. Okay, let me give you a few more examples. Let me see. Okay, let's see, euro dollar daily. Okay, let's start with euro dollar. So basically this is a euro dollar. Again, I'm starting from top down. Yeah, so this is euro dollar weekly chart. Okay, very clear that it's bearish, isn't it? It's a downtrend. It broke a key level of 1.28. Okay, all good. And then we move down to a daily chart. So this is where I start stocking the trade. So my bias is to short, correct? My bias is to short. Now, the daily chart. Now, what do you think the daily chart is telling here? Is it an uptrend or downtrend? What do you guys think? So this is daily an uptrend or downtrend? Okay, Ravin said bearish. Winston said downtrend. TC said up. This is actually up. Raymond said down. Down, some said up. Oh, this is almost 50-50. Okay, the daily chart is actually an uptrend. Okay, because yes, Peter, you're absolutely right. It's actually trend changing because you see higher low, higher high. Okay, but the reason why I'm bearish is because my trade plan is based on a weekly chart. Okay, so not every time all the time frame saying same thing. So my weekly chart is very bearish. I know that 128 is a very, very key resistance level, but my daily chart is telling me a different story first. But I'm bearish based on a weekly chart. So that is the chart I'm basing my decision on. Okay, so even though the daily chart is an uptrend, I won't be so gung-ho and just jump into short like that. All right, but I'm just waiting to see what happens at the 128 level. Okay, and then I go to lower term time frame, 4-hour chart. And you can 4-hour chart, you can see that it's slightly more consolidating, isn't it? Yes, Raymond, always respect the high term time frame. So you can see that again, weekly chart bearish. My trade plan is based on weekly chart. My bias is based on weekly chart. Daily chart uptrend. Okay, so what I'm waiting for is some kind of confirmation at the 128 level, the key resistance level on the lower term time frame before I take the trade. And 4-hour chart is actually sideways. But one thing you can see, the 4-hour chart is very toppish, isn't it? It's showing signs. It's showing very toppish signs. You see that? This is like what, a quadruple top level. Okay, but you can see there's a very key resistance level, the 128. Okay, so how do I plan the trade is basically, I need to bring up this so you can see better. Okay, so you can see that the circle I drew here. So the 4-hour chart confirmed my bearish bias on weekly chart when it actually made a lower low. You see this? You see this lower low? Okay, and when it pulled back, I took a short. This is my risk is above the previous high, and my first profit target is all the way back to the bottom. Okay, and this happened after that. All right. See, and if I was patient now, this is actually the 4-hour chart. It went down to 126.50, but if you look at the weekly chart, right, it actually came back all the way to 124. That's almost 400 pips. You see that? Brian, good question. Brian's asking, why not just wait for a reversal candle on a weekly at a resistance? You are absolutely correct. You can wait for a reversal candle. It's just that for me to be a bit more precise, I want to wait for the short term to confirm as well. Raymond, you're right as well. You can say wait for pin bar reversal. Now, the thing in price action, right, how you enter the market is there are many, many ways. Some of you might have read Neil Fuller. Some of you might read. There are a lot of price action gurus out there. Okay, the general analysis is the same. Okay, but how you enter can be very different. Some of the gurus don't even believe in pullbacks. They believe in entering after you see a downtrend or something like that. So what you're saying, Raymond and Brian, is absolutely correct. It's not wrong. In fact, your reversal candle is actually shown somewhere here, something like a bit of a bearish pin or whatever you call it. But for me, I like to go down to lower term time frame to seek confirmation. Sorry, I like to go down to lower time frame to seek confirmation before I enter. But you guys are absolutely correct, so. Okay, so how you enter, it really depends on your style, what you're used to. All right. All right, so that's the example. Mr. Chang said, for this example, will you take long trades? No, absolutely not. This is my bias is short. Remember, my bias is based on weekly chart. So once my bias is there, right, I would very seldom change it unless there's a big change in the market based on news or something. But no, I wouldn't change it. And there are definitely no long trades here. Definitely short all the way. Okay. One question: what if, based on this example, right? What if instead of the market coming down, what if the 4-hour make a higher high and starts pushing up? What should I do? Or what should you do? So for this case, it was nice, right? The price breakdown support confirmed that it's coming down and short based on my bias. So what would you do if the 4-hour actually broke a new high? Okay, most of you got it right. I would just wait and see what happens. Okay, because Mr. Chang said buy at 128 pullback. Nah, it's a bit risky for me because the weekly chart, my bias is still based on weekly chart, so I'm still bearish. It's just how the nature of the weekly chart. Okay, so I'm just waiting for it. If it doesn't come down 128, maybe you go to 123. But my trade plan is still bearish because I want to base on the weekly chart. Okay, so if the 4-hour were to actually make higher highs, I'm just going to wait and see. Okay, because sometimes the market is quite tricky. Yeah, just when you think that your trade has disappeared because it's making a higher high, the next thing you know, it just boom comes down, and then it will just come down like that. It happens many times. Happens many times. Okay. Yep, correct, Raju. You're absolutely correct. So Michael is asking, how often should we monitor the trade? Okay. I'll cover a bit of that later. Okay, let me just cover one more example before I move on to a bit more psychology stuff. Okay, so silver, weekly chart. My bias is bearish. Okay, quite similar to the previous euro dollar trade plan because the 1850 was broken, key level was broken. Okay, and what I was waiting is for my daily and 4-hour chart to confirm. So just waiting. Okay, daily chart is still mugging around here, doing nothing much. Okay, now ideally, right, I want it to come back to 1850. Okay, because when it makes new lower low, okay, normally you want to let it retrace to 1850 before shorting again. Okay, so this is the daily chart. Still mugging around there, still not going to my 1850, which is the blue line. Okay, and then I go to my 4-hour chart. Now, you can see the 4-hour chart is sideways. Okay, so for this case, it's slightly different. Weekly is down, daily is sideways, 4-hour is sideways. Ideally, I want it to come to 1850. See the top line here? I want it to come to top here because this is a good resistance level. Okay, but it's sideways right now. Now, what happened is this. Sometimes the market doesn't pull back exactly the way you want. For the euro dollar example just now, 128, very beautiful. But for this case, okay, I'm willing to take the risk if the market break a key 4-hour support level. Okay, and this is my risk. So my trade plan was to trade a breakout of the 1700 support. If it breaks below, my risk is above the previous high, and my reward is all the way back to the 1000 level. So this is what happens. Okay, this was a beautiful trade. Now, again, nothing is 100%. So is there a possibility whereby I do a trade and the thing shoots up again? Yes, of course, nothing is 100%. But what I'm trying to show you is how to use price action, incorporate it with multiple time frames to enter a low risk, high reward kind of trade. Okay, by combining different time frames. Yep. Okay, and the weekly chart actually came down really nicely. So sometimes it doesn't want to retrace to your level at 1850, but you got to be sharp enough to take it on a short-term change of trend. Okay, any questions? Okay, Mr. Chang, for this pair, you will stay out of the market for a few days to weeks. Depends, Mr. Chang. Not a few weeks is a bit too long, maybe a few days. Yeah, but I'll just continue to monitor. So for me, if you form a bias on the daily or weekly chart, right, unless the whole chart changes, then you might want to change your bias. But if not, I'll be happy to stick to it and just wait for short-term confirmation and get in again. All right, but the key thing is you must be confident on your strategy and your psychology must be strong, because sometimes you might make 1 or 2 losses, then the market will follow your bias on a higher time frame. Okay, so you need to be able to pull the trigger again, and that's where your risk management comes in. Yeah. Okay, so no questions, right? I move on to the last part of my webinar, which is about 10 minutes, which I'll talk about psychology. So the whole idea is that our trading is a lot about trade planning. And if you see this, this is a very famous trader, Mark Winston from Market Wizard Books. It's basically talking about cheetah. Okay, you see the cheetah, it may hide in the bush for a week waiting for just the right moment. It will wait for baby antelope, not just any baby antelope, preferably one that is sick or lame. Only then, when there's no chance it can lose its prey, does it attack. That to me is the epitome of professional trading. Okay, so it's all about planning the trade, being patient, and with opportunity there, you stick it. Okay, so it's about being very precise and planning your trade properly. Okay, now the final part of the webinar, I think some of you might have heard this before because I covered this during my last live Technical Tuesday. It's a bit more psychology. So whatever I covered for the past 1.5 hours or so, it's a lot of strategy, how to analyze the market, this and that, blah, blah, blah. But essentially, right, this for me is only 30 to 40%. I'll say about 30% of trading. Okay, the other big portion of trading is all about psychology. Alright, psychology is a very, very big part of trading. Alright, you can, because there's no 100% strategy out there. And I did mention this before, but I think in the Singapore context, there are a lot of courses focus a lot on strategy, which is not wrong, but there's just too few psychology instructors out there in the Singapore market. Okay, but psychology is very, very important, right? And basically, I was featured in the Straits Times in June, 29th June, whereby they were asking me about how I combine Zen and the art of trading. Okay, it's basically I do a lot of meditation, or they call it centering, and practice of mindfulness, and basically it helps in my trading quite a bit, especially when I'm trading from a source of confidence and calm rather than anxiety. Okay, a lot of times when you're facing the markets, right, you can get very anxious, and the decisions that you make might not be the best, right? In fact, a lot of times I get caught as well, whereby my trade plan is to buy, but I don't know what I did in the end. I end up selling, getting caught in the lower term time frame, this, that. So something that you want to look up for is knowing how to manage your own psychology. It's much, much tougher, easier said than done, all right? And I call it the disease of the 21st century. People think too much, but in terms of trading, right, there's this thing called over trading as well. All right, any of you, oops, sorry. Any of you heard what, any of you know what over trading is? Okay, so over trading, right, it's, I mean, some people say they keep trading because they're impatient, they feel the need to be in the market, they feel that they're missing out, they feel frustrated that their analysis is correct, but they're not in the trade. Okay, but to me, like, over trading is either you take any trade outside of your trade plan, or you take any trade which cause you to exceed your normal risk limits. Okay, so again, over trading to me is either you take any trade that's outside your trade plan or strategy, or you take any trades which cause you to exceed your normal risk limits. That's over trading to me. And it can happen a lot. Okay, it can happen a lot to anyone, a lot of times, especially when you're sucked in. Yeah, because trading is tricky, especially when the market is moving, and the key thing that's causing you to get sucked in is money. Okay, we are mostly very attached to money, isn't it? Especially in society in Singapore, by we want to make the most money in the shortest period of time all the time, and so that's where overtrading can come in. All right, and that's very dangerous. And the key thing is to be able to pull yourself back. If any of you are looking to be a full-time trader or use this as a main source of income, right, you need to be able to prove to yourself that you know when to pull yourself out when you get sucked in. Okay, because it's those times where you get sucked in whereby you can totally destroy your account. Okay, all your hard work, your little profits here and there for the past 6 months, 1 year, a moment of foolishness because you got sucked in and you don't know how to pull yourself out, that's where it can destroy your account. So if you want to be a full-time trader or treat this as a primary income, you need to prove yourself that you can pull yourself out from such situation. Okay, so overtrading is a very, very key thing that you need to overcome. Now, how do you solve the issue of overtrading? Anyone? The issue, how do you solve overtrading is basically number one, you can write out your trade plan. That's one way. Okay, what I do is that I literally write out my trade plan all the time so that, yeah, exactly, TC. You write down, you said throughout the day, right? Even when you're busy at work, you just keep cross-referencing to write down so that you won't do funny things. Okay, write down and be disciplined enough to stick to it. Okay, and another way that you might want to look up for is by calming your mind down, and that's where you can look to. Okay, that's where you can look to disciplining your mind. Okay, and how do you discipline your mind? Is basically you can practice what I call breathing. Okay, it's basically being mindful about what you're thinking, being mindful about your actions in the market, is being mindful about your strategy. Okay, and that's what I call, you can use something called breathing. So the benefits of mindfulness in trading. Now, how do you be mindful in trading? Okay, that's where what I do on a daily basis, that I meditate or I do a lot of centering at 10 minutes a day or before a trading session. I just close my eyes, okay, and I take like 10 deep breaths, like literally 10 deep breaths, and I put all my focus in the breathing. And what it does is that it sort of like calms my mind before I start trading. And this is not something that can help, in one go or just 1 week. It's a consistent thing. Okay, because your habits, your bad habits of being anxious, of overreacting, over trading, it's very hard to take away unless you're unless you're consistent in your practice of being mindful to it. Okay, so one way you can try is basically just close your eyes. Okay, and just take 10 deep breaths. Inhale through the nose, exhale through the mouth, and just be mindful. Just focus on breathing. Now, what you realize that when you do that, there'll be a lot of thoughts coming to your head. Okay, it's inevitable. Okay, but the key thing is not to control the thoughts. If you're focusing on breathing and you realize that thoughts are coming to your head, just accept the thoughts and just let it go, and then go back to focusing on breathing. So just imagine that there's a puppy on a leash, okay, and the puppy is very playful, right? So the puppy is like your mind. It likes to wander. So every time when you close your eyes and focus on breathing, if the puppy wanders to the side, all you need to do is just gently pull it back to center. If it goes to the side again, all you have to do is just to gently pull it back to center. And what you notice that over time, the puppy, which is your mind, will be able to walk in a straight line. And that's where your mind is in a calm state most of the time. And that is the kind of mindset that you want to take when you're approaching the markets and when you're trading. Okay, because this is the benefits of mindfulness trading. It's basically you're increasing awareness. And for me, the key thing is just to be able to pull yourself out whenever you get too sucked in. Okay, because trading has this emotional grip on you, especially when it's involving a lot of money, more so when you're trading for other people. Okay, because of the emotional attachment. So it's not easy, and that's where mindfulness can really help. Okay, I just thought it's something that I wanted to share with you because it really helped me across my years in trading. A lot of people think that psychology is the last thing that is important. Trust me, I've done a lot of, I've been through a lot of seminars outside or workshops whereby, when it comes to strategy and some holy grail approach, everybody will sit down there and pay attention very attentively. But when the psychology slide comes, people will start leaving, people will start getting bored. Okay, it's just, I don't know why, it's just nature. But having been in the market for 5-6 years, right, I noticed that psychology is actually very important. Right? For those of you who are still caught in chasing the best strategy out there, there's no such thing as the best strategy. The best strategy is something that suits you and something that you can practice over and over again and achieve consistent results. That's the best strategy to you. So once you find some strategy that suits your character, move on to psychology, and that's where you can do mindfulness like what I do your centering, do your breathing, and just make sure you understand yourself as a trader. And very, very important, you need to do journaling as well. Okay, journaling as in you can what I do is that every time I enter a trade, I take a screenshot and I put it in a PowerPoint slides, and over the weekend I review it. Okay, so journaling, being mindful, doing breathing exercises, doing yoga, like what Sunil suggests, or Eugene suggests, whatever it is, calm your mind down so that when you're trading, you're approaching it from a calm state as well. Very, very important. And yes, it helps daily life as well. Thanks, X. Yeah, basically it helps in all aspects. Okay, I ceded my time, not surprising again, but I really hope that you guys benefit from this session. I mean, my weekly webinars are on a fortnightly basis, but okay, this webinar will be recorded. This is more theory. For those of you who attend the Technical Tuesdays every on a fortnightly basis, hopefully this webinar can help you understand so that when I go live market, it's easier for you to pick up what I'm looking at. Okay, for those of you who are totally new to trading, I hope I didn't confuse you. You might want to watch recording again to understand price action. But to me, price action is very, very useful. Okay, very, very powerful tool in the markets, and you might want to master it. Okay. If not, again, thank you so much for coming by for today's session. Don't forget to always be careful in the markets and always focus psychology. This is very important. Okay, if not, again, thank you so much for coming by. I'll catch you guys next Tuesday. If you guys have not registered, you can go to the website. It will be on 29 November, 7 p.m. where I'll do a 1-hour live market analysis. All right, thank you and have a great night, everyone. Cheers.